Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures steady this morning after a tech-induced sell-off weighed on the major averages yesterday. Shares of Palantir falling nearly 10% in Tuesday's trading session, while chipmakers Nvidia and AMD took a beating as well. The S&P 500's recent record-breaking rally has some on Wall Street wondering if it's run too far, too fast, with just a few tech names powering the index. Plus, we've got Target shares falling after the company appointed a new CEO, the retailer choosing an insider to replace Brian Cordell, who's been at the helm for over a decade. Michael Fidelki was unanimously chosen, elected by Target's board, and he'll be tasked with reversing a streak of weak performance and the loss of market share to Walmart and Amazon. Wall Street had been hoping for an outsider to lead the company. And amid reports the U.S. government is weighing a stake in Intel, Reuters now says the White House is considering taking stakes in other businesses. Commerce Secretary Howard Lutnick told CNBC he's exploring a stake in Intel in exchange for giving the company CHIPS Act funds. Lutnick's comments suggesting any stake would be non-voting, meaning it would not enable the U.S. government to tell the company how to run its business. Let's get a check-in on stock futures here this morning. After that big sell-off in the NASDAQ yesterday, we are still seeing a little bit of follow-through on that selling for the NASDAQ, specifically indicating a drop of about 1/5% at the open, although not seeing the magnitude of the kinds of losses that we saw yesterday. The Dow just flipping into the red just barely, and the S&P 500 also indicating a lower open. Let's dig into our top stories of the day now. The tech trade cooling as investors rotate away from some of the biggest names in the sector, and, by the way, those that have been the best performing, and also results out from several retailers. Target announcing a new CEO as sales continue to sink, plus Lowe's seeing same-store sales return to growth. Joining me now, senior reporters Brooke DePalma and Josh Schaefer. And Josh, I want to start with you. And, as I mentioned there, we saw some big, not just single-day drops. Some of them have seen some losing streaks over the past few sessions. But also we need to put all this in context that many of these have had big up years here before this most recent pullback.
Yeah, Julie. So yesterday you had the S&P 500 fall about 0.6%, but you actually had over 350 stocks in the index in the green on the day. So what that really tells us, as Citi's Stuart Kaiser pointed out, the pain remained localized in the stock market yesterday. It was really just large cap tech that was feeling the pain. Some of those momentum trades, the stocks that felt like they were going up every day because they were going up every day for about a month or two period, those have been pulling back in the last couple of sessions. So I want to just take a look at the Wi-Fi Interactive here, and I can point out some of the names that we've been talking about. Palantir down almost 10% yesterday. Broadcom was down over 4% or almost 4%. AMD down over 5%. But you zoom out on a year-to-date chart on Palantir, and the stock is up 108% this year, right? So what you're seeing is it's finally starting to come back a little bit. Even Nvidia yesterday was down over 2%, but you look at Nvidia since the market bottom, right? If we put a 3-month chart on here or even a 6-month chart on here, the stock had essentially just been going up in a straight line for a lot of that rally. So you saw a pullback, but really what I wanted to focus on here on this board, look at where your red was and your dark red. Mainly large cap tech. If you look at where the smaller stocks are within the NASDAQ 100, that's down in your bottom area here, there was a fair amount of green. So there's still things working in this market. And so what does this mean from an investment perspective? This is what strategists have sort of been warning about, right? To make sure if you're an investor that's worried about an AI pullback, that you have some diversification within this market, that you're owning other stocks within the market. And broadly speaking, for the bull market that we talk about all the time in this chug higher for stocks, strategists would argue this could be a good sign. If you have other sectors start to work, then perhaps that means the bull market is earlier in the cycle. The kicker with that, though, Julie, of course, large cap tech is a big part of the index. So when that goes up, the index goes up a lot more. If it's just the other 7 or 8 sectors working, you might not expect those large gains that we saw in 2023 and 2024 from an index perspective.
Right. You need that tech participation. Josh, we've been talking a lot about waiting for Jay Powell on Friday. We've got Fed minutes today. But really, a lot in the market are looking a little further out to next week and Nvidia earnings. And John Vinn, who's been a pretty consistent bull on Nvidia, was out with a note this morning previewing those numbers. And even though he's still bullish, He also kind of sounded maybe something that will not be as positive potentially in those earnings.
Yeah, so what Vin was highlighting in that note, Julie, is the fact that Nvidia might not have a full outlook or full scope on what will happen with their business in China. Because of that, Vin thinks that they might disclude China from their third quarter guidance and therefore would maybe miss street estimates. This would be a rather big deal. Of course, we're talking about it now, so maybe you could argue it might be expected to some extent when that release comes out. But remember, when Nvidia has reported earnings for the better part of 2 years now, it has been the prior quarter beats street estimates, they raise their guidance for the coming quarter or the current quarter, and it usually beats street estimates for that current quarter guidance too. So it'd be a shift in what we've seen from Nvidia, which has just been consistently strong results, better than expected. But as you pointed out, sort of the flip side of what Vin is arguing, he raised his price target on Nvidia. Right. He said looking into 2026 and 2027, so the longer term, he still feels good about the business once that China headwind sort of gets a little bit more cleared up and we have more clarity. $215 price target on the stock. I'm looking at Nvidia shares this morning. They're changing hands around 175, so he still sees some upside over the next 12 months. But maybe an interesting warning to think about when you think about those earnings next week coming as AI has started to sell off a little bit. If Nvidia doesn't come out with as strong as results as normal, it will be interesting to see what that does to this sort of AI hiccup we've been following.
Yeah, and I think that 215, it's not even the highest price target on the street by a long shot. There's a lot out of there who are even more optimistic. And Brooke, let's talk retail because we got some interesting numbers this morning, and perhaps even more interestingly for Target, the announcement of a new CEO.
Yeah, shares of Target right now are down more than 10% in pre-market trading after they announced that COO Michael Fidelki will in fact take the helm come February 1st as Brian Cornell, the current CEO, is set to retire. Of course, he signed on to a 3-year agreement that comes up and ends right about now. And the street's certainly reacting to this. Some sources that I've spoken to, even before this announcement, said that if Fidelki does take the helm, they said that investors might react this way because it's more of the same. But what we do know is that the company said on its earnings call that they led an extensive search of both internal and external candidates. But Fidelki has quite the job ahead of him. They beat on low expectations. They also said that even though they beat across the board, traffic and ticket size did come in lower yet again. The company did stand by its full year guidance. They still do expect that low single-digit decline in sales. But it's important to note here that digital sales were a bright spot, rising 4.3%. Target also has a strong inventory problem. Inventory was up 2.2%. That was lower than what the street had expected. But Fidelki is an operations guy, and so certainly investors are hopeful that he'll step in. He did emphasize on the call that he's stepping in with urgency to really turn around, as you can see, the sales slump that Target has seen over the past 2 years.
Yeah, not a lot of optimism being expressed in those shares this morning. And then we got Lowe's on the flip side, which again, kind of dual news here, right? Came out with the numbers and also announced an acquisition.
Yeah, two things that are really boosting investors' optimism around the stock this morning when it comes to Lowe's. We know that Lowe's primarily caters to that DIY customer, and now they're announcing another acquisition when it comes to their investment in their professional businesses. This morning, they announced that they plan to acquire Foundation Building Materials. That's a distributor of interior building products like drywall, insulation, metal framing. They're planning to acquire it for billions of dollars there. They also closed on Artisan Design Group. That's a design, distribution, and installation services. So certainly investing there. We did see a beat on earnings and a miss on same-store sales and revenue. But in addition to that, they did stand by, or rather raise their sales outlook for total sales, but they still do expect sales growth to be between flat to up 1%. And Lowe's CEO saying in the earnings release this morning that this quarter the company delivered positive comp sales driven by solid performance in both Pro and DIY. Despite challenging weather early in the quarter, he went on to say that their teams drove both sales growth and improved profitability. And this is what investors were really hoping for after Home Depot had reported yesterday, and they also stood by their guidance instead of cutting their forecast. And there really is this stronger optimism that the housing market eventually will return and consumers will return to those larger discretionary projects of redoing their house.
Brooke, Josh, thanks very much. Well, the Trump administration is considering taking stakes in chipmakers as part of the CHIPS Act grants program. That's according to Reuters. The report follows comments from Commerce Secretary Howard Lutnick, who said the government is eyeing an equity position in Intel as part of its funding package. Joining me now to discuss, senior tech editor Dan Howley. So the CHIPS Act originally, right, there's been a lot of talk lately about sort of state capitalism or the melding of government with these private enterprises, and this is the latest step here. So could have implications, obviously, not just for Intel, but maybe for other chip makers.
Yeah, and some of the chip makers that, the Reuters report points out that they may be looking at is Samsung and TSMC, two of the largest chip makers in the world, Micron as well. Micron received a huge amount of CHIPS Act funding, but TSMC and Samsung also received funding for their plants in the U.S. TSMC is building out a number of facilities that Apple will take advantage of, Nvidia will take advantage of. Obviously, they build chips for AMD as well. And so, the idea that these companies, the TSMCs, the Samsungs, may kind of count the U.S. government as a shareholder if they convert these grants into equity could kind of, raise the prospect of whether or not they would actually want to keep a hold of that CHIPS Act funding. It's not as though TSMC or Samsung are hurting as much as Intel. They really need that kind of cash infusion and any kind of help they can get from the government. Obviously, Intel is getting that $2 billion from SoftBank Group as well. But the idea that we could see the government kind of having that stake in two companies that are one Taiwanese, one South Korean. I mean, it kind of seems a little odd at this point, especially considering that the whole point of the Intel stake is to right that ship. As I said, it's not as though TSMC is doing poorly. Samsung's had some rough quarters, but they are still one of the biggest chip makers around. They don't really need the kind of shoring up that Intel does. So it does seem a little odd to kind of change this. But, in that Reuters report, they mentioned how Lutnick had said that the CHIPS Act grants were overly generous. And obviously, President Trump has expressed his displeasure with the CHIPS Act, saying that, they should have raised tariffs on the companies instead to get them to come to the U.S. and then, maybe give them tax breaks rather than give them grants or the option for loans.
Well, Dan, we will see how it all evolves. And indeed, if any of these chip makers that we're talking about end up taking some of that cash, we'll see. Thanks so much. Coming up, is the tech sell-off over on Wall Street, or is more pain ahead? We'll discuss next after the break. Now time for some of today's top trending tickers. We are watching TJX, Estee Lauder, and Dayforce. First up, TJX shares surging after the off-price retailer raised its full-year guidance thanks to strength from buyers searching for deals. The TJ Maxx and Marshall's parent company topped revenue expectations in the most recent quarter. That momentum is holding up. The CEO noted the current quarter's off to a strong start, too. The company also said it expects it will be able to offset significant tariff pressure over the next year. Next up, Estee Lauder issuing a weak profit outlook for its fiscal year thanks to a projected $100 million hit from tariff cost. Home to brands like La Mer and Clinique, Estee Lauder says it will attempt to offset more than half of the tariff costs through supply chain optimization. Sales fell 16% in its largest business, which is skincare, and 11% in its makeup division. Both were hurt by a still challenged Asia market. Heading into the results, several Wall Street firms did upgrade shares of the beauty company. JP Morgan and Morgan Stanley analysts both moved to overweight on the stock, and they had expressed optimism in Estee Lauder's longer-term turnaround efforts. And finally, Dayforce on Wednesday confirming reports that it is in talks with private equity firm Thoma Bravo for a potential acquisition. The HR software company said the two were in advanced discussions for a $70 per share deal that will value Dayforce at about $11.2 billion. Thoma Bravo has already struck deals this year to buy Boeing's flight navigation unit and restaurant software company Olo at a time when PE activity has been pressured by higher rates. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the sell-off in tech stocks is easing after taking a hit in Tuesday's trading session. Some on Wall Street asking if the record stock rally has gone too far, too fast, with just a few names driving the benchmark index. Joining us now is Goldman, Cetera Financial Group CIO, joining me here in the studio. So, Gene, people always ask this, right? Like, have they gone too far, too fast? But the last few years are a story of tech stocks just continuing to push higher and higher and higher, with some pullbacks in between, sure. But kind of where are we right now in that whole back and forth?
Yeah, and first of all, Julie, thanks for having me back on your show. Let me kind of use an analogy. So football season starts in a couple weeks. So for me, the markets today feel like preseason football. Very sloppy right now. But more importantly, when fundamentals, when the stars come back into the game, they will win when it counts. So what does that mean? Near term, earnings are going to be uncertain, high valuations, and the fact the Fed's all uncertain. We've been saying for a while, we expect the markets to pull back 5 or 10% in the S&P 500. You can look at the PE ratio, 22.5 times forward earnings. You can look at market breadth has been terrible in a rising market. And the fact what you alluded to earlier, the S&P 500 is up 28% since its market low, highest and quickest move in recovery in over 50 years. And you have an uncertain Fed, but we continue to be a buy the dipper. We're buying these dips because, as we said the last couple of years, corrections, these pullbacks, these 5 to 10% pullbacks are a normal part of investing. If you look at the last 45 years, the stock market has averaged a pullback, a drawdown of about 14.1% per year. This pullback that we anticipate is a normal part of investing. And you add on top of this narrowness of the market. The top 10 names in the S&P 500 are 37% of the index. So you have a little bit of AI uncertainty. We still like AI, but valuation uncertainty, similar to DeepSeek, when that hurt the AI market back in January and February, we're seeing the same type of uncertainty right now. All this together leads to us to a 5 to 10% pullback.
Okay, but when do the stars come back, so to speak? I mean, is that Nvidia next week reporting earnings and reigniting things?
I think there'll still be a little caution going into earnings season still next week. I think the key thing will be the Fed and the Fed's decision. I think the Fed's decision is really the overarching effect. What will the Fed do? Obviously, Jackson Hole is Friday. We'll see. I think Powell he's not a dove. He's not going to be a hawk. He's going to be a very wise owl and look at the data. So we'll see what happens coming out of this data. So I think we'll see there. And then more tariff news. I mean, we're optimistic that there's a lot of cash on the sideline. There's $26 trillion looking for better valuations. Earnings next year look phenomenal. Large caps, for example, the S&P 500, earnings are expected to rise 13.5%, mid caps 17.5%, small caps 21%. Markets price this in about 6 to 9 months in advance. They will price this in. And you also have the fact that the trade war we're having right now, yes, you talked about Estee Lauder, uncertainty, the $100 million tariff hit. But good news is that with the trade war, fewer trade barriers are going to help us help our economy.
Walk me through that last part.
Sure. So the tariff war, the trade war, obviously the negotiations going back and forth. And at the end of the day, we feel we have the trade war advantage relative to other countries. Let's just say China, for example. China has advantages, rare earth minerals, access to consumer goods, but we still have a sizable amount of consumer spending as relative to GDP. 60% here, 70% here in the US, China's about 55%. That's a huge trade war advantage. So as these trade negotiations take place, these tariff negotiations, we do think some of the trade barriers will start to come down a bit, which will help our companies sell outside the U.S. You look, for example, at Europe, these value-added taxes, these can start to come down. Reduced trade barriers will help our economy.
Okay, we'll see how that plays out over the long term. Okay, in the short term, kind of where are you looking then? Are you looking to sort of, again, to go back to your analogy, the stars to pick up there? Sort of some of the outperformers after they dip to come back up?
Sure. Let me go back to a football analogy, if you don't mind. So I feel like I'm a quarterback at the line of scrimmage. I'm going to call it audible, and that's what we're investing in today. So audible, AUDIBLE. Allocate to undervalued, diversified investments based on long-term earnings. So with that in mind, we're overweight small caps. Small caps are extremely cheap right now, and strong earnings expectations.
Let me stop you right there. Yes. I've been hearing this small cap thing.
Yep.
2 years at least that they're going to come back?
Yes.
They haven't come back, Gene. They've only gotten cheaper and they haven't come back.
This time is different.
Why?
Because the Fed is going to be cutting rates. We don't think the Fed should cut rates as much as the markets have priced in, but there's an 85% chance the Fed cuts in September. Historically, when the Fed cuts rates, market breadth widens. You see small caps and mid caps do well. Also in a similar vein, we do see value doing well. So specifically, which areas? We like technology a little bit, especially being very selective in some AI companies and also in cybersecurity, but we love industrials. We love financials. Those do very well when value outperforms. Financials do well in the steepening yield curve, and industrials do well with defense spending.
So you not only think these guys are going to do well, you think value is going to outperform growth once again once the Fed starts cutting? You think
so.
Tech is not going to still be on top?
We think tech, there'll be a shift in tech. Investors will be more selective. This is why we continue to stress active money management. Investors today are just buying indices like crazy. Take a step back.
I mean, it's worked pretty darn well.
Yeah, but things don't work all the time. All the time, things go through cycles. I know active money management has struggled in 7 of the last 10 years. We do think it comes back because you have more volatility, more uncertainty, and the fact that you just have widening market breadth, which we expect as the Fed cuts rates. Active money management helps to navigate the tech uncertainty.
All right, Gene, thanks for coming in.
Thanks, Julie.
Good to see you. Coming up on Yahoo Finance opening bid, executive editor Brian Sozzi is joining us now. Soz, I know you're always fired up for the show, but I feel like maybe you're even more fired up today.
You know, Julie, every so often you just get that news story that gets into your soul, and it just excites you more than normal news stories. And that story today is for me for Target. This CEO shakeup, I've covered this company for about 20 years of my life. I've followed now outgoing CEO Brian Cornell since day one. He was appointed CEO in 2014. I know the new guy coming in, so we got a lot of analysis. Julie, I'm excited to welcome Jeff Mackey back to Yahoo Finance. Really excited to talk to him this morning on all things Target and retail.
I'm excited to hear him. Have you done any channel checks lately? Any shopping at Target lately, Soz?
It's very simple here, Julie. Target just needs to put more things on its shelves that people want to buy.
Okay.
It's that simple.
That sounds simple. All right, looking forward to that conversation. That does it for Morning Brief. Much more ahead on Yahoo Finance.